Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
And welcome back. I'd like to start off by just thanking everybody that came out on Thursday. It was pretty interesting. We had a huge number of people sign up, and then the weather turned really bad, but it cleared up on Thursday. So actually there were over 100 people at the seminar. I just wanted to say thanks for coming. It was a lot of fun. I promise I'll never talk that long again. I went for an hour. We took a 15-minute break, and then I came back to talk about a second, which was not mandatory, by the way. The second half of that was answering questions, talking about the Look Out for the Bull website that'll be up fairly shortly. So I do not get offended if anybody leaves at before the second portion. So keep that in mind, all those of you that came. The second portion is really kind of a bonus, but I do appreciate that almost everybody stayed. That was kind of interesting. So anyway, got a pretty good show lined up today, I think. We've already set up the next seminar, and I have to look that up because I don't remember. Oh, this is pretty funny. You know, the name Bullington's not very common. That's kind of wild. I just typed one in, and there's one up there. Pretty amazing. Anyway, so we've got seminars, and the next one's going to be May 11th. That's a Thursday night, corporate college, and we're going to be talking about the key to successful investing, choosing an investment strategy that suits you. And it's not going to be a lot of mumbo jumbo, I promise. It's relatively simple. In fact, simple strategies tend to outperform complex strategies most of the time, which is kind of interesting. So anyway, but you got to get one that matches your personality. And we're going to talk a lot about this going forward on the program because it's really important. You know, the number one mutual fund manager of all time, his name was Peter Lynch. He had the best track record. The track record still stands. He ran a Magellan fund for Fidelity for about 13 years. Prior to that, he was an analyst. That's how kind of Fidelity kind of works. You start off as an analyst, and then they, if you do well there, they track your recommendations. They put you in charge of a smaller fund or a co-manager of a big fund. Peter Lynch actually had a bunch of co-managers. One of them still managing money quite successfully, I might add. And anyway, this guy, if you put $10,000 into his fund when he took over, 13 years later when he retired, it was worth $330,000 without adding any money to it. No one else has ever done that, at least not yet, not in a publicly held mutual fund. So anyway, the really interesting thing was I read in one of his earlier books, and I can't remember which one it was, but no, it wasn't a book. It was an interview. I think it was in Barron's. It was either Barron's or Wall Street Journal, one of the two. And he was being interviewed, and they asked him if he had any regrets. And he said, the only thing that he really didn't feel good about during his tenure running the Magellan Fund was that more than half the people who had invested in the fund while he was managing it actually lost money. And how do you do that? It's actually pretty simple. What happened was they saw the performance, they got into the fund. When the fund experienced a drop because markets go up and down, they pulled out and lost money. And then I was at a meeting with one of the heads of the research department at Fidelity, and they told us, well, the actual number was more like 2/3. Think about that for a second. 2/3 of the people that had managed to locate, they identified the number one mutual fund manager ever to live, and they managed to lose money. Yeah, I get it. I really get it. And this was before the internet. This was before, people like me did stuff like this on the radio. They couldn't explain that no. Corrections are normal. That's a normal part of the market. So if you have problem handling volatility, don't put all of your money in something. That's a big part of what we're going to be talking about at that seminar. How do you gauge the amount of risk you're taking? And I've got a relatively simple method. I'm going to disclose it there. We talk about it every time somebody comes in to open an account at Bullington Capital. We talk a lot about that. In fact, it's almost the only thing we talk about. And I will tell you this. 4 out of 5 people that come into my office are because they don't know, what their nobody's told them how volatile stocks can really be, and they keep hearing all these ads everywhere. Oh, you can get rich with little or no risk. Yeah, good luck with that. Good luck. You've got to have risk to make returns. You have to have it, especially today. But you don't have to go overboard, and you don't have to put so much money into something that when it starts to drop that you panic and pull, because that is not a good way to make money. In fact, that's almost a guarantee that you'll lose money. So putting a strategy together that suits you is key. That is key. And firms like mine, we can invest in anything. I can literally invest in anything I want to on behalf of my clients. So getting to know somebody, asking a couple questions, finding out what their backgrounds are, how much income they have, how much income they need to generate, all that type of stuff, have that in a conversation. It's relatively simple. Then presenting the various styles, investment styles, the logical ones, the real ones, not the you can get rich, I'm going to make you thousands of percentage points with very little risk. That kind of stuff doesn't really exist except in the $3,000 systems that people are selling. And then you find out really quickly that that's not going to be reality. So anyway, I think it's really, investing is all about you. That's what we're going to be talking about. Investing has to be about you. What are your goals? What do you need to achieve? How much fluctuation are you willing to accept? And that, by the way, that is the hardest question. I have a little questionnaire that we have to go through. We're required to go through before somebody opens an account. And that's the one question people struggle with. How much fluctuation? And, that's when panic mode sets in. And that's why I have a job, quite frankly, to help you try to identify what kind of risk taker you are. And at this stage of my career, it's actually relatively simple for me. It's very difficult for an awful lot of people, and many people just can't come up with an answer. They're like the proverbial bottle floating in the ocean. Which way do you want to go? Any way the waves are pushing me. That's tough. That's really difficult to be a successful investor if you don't decide what kind of risk taker you are. How much fluctuation are you willing to put up with? And once you've done that, I can show you, and that's what we're going to talk about in December. I'm going to take some real live examples. Here are situations that I've encountered in the past. By the way, in fact, the examples I'm going to be using are people that came to me 15, 20 years ago who passed away. Okay, that's one of the other strange parts about being an investment advisor. You actually have an awful lot of people that are much older. It takes a long time to accumulate a lot of assets, by the way. You young people out there, you should listen up because you guys have one of the biggest opportunities that has ever been available to anybody. I mean, the way things are going in this country, they're going great. Don't listen to the media. Media can't sell ads on good news. You know why? Because when you hear that everything's honky-dory, everybody takes off and does something fun instead of clamoring to read more or get more information about it and worrying. And I'm telling you right now, things are really good. Things are really good. And they're improving. And the economy's improving. And there are businesses that are growing. First time in about 8 years, instead of companies just buying back their own stock, they're actually starting to invest in the economy, in the growth phases. There are lots of things happening. We'll talk about that later in today's show. But I just want to let you know, things are good. Things are really good. But you still have to identify what kind of investor you are if you want to be successful. If you don't want to be successful, just keep doing what you're doing. The average investor doesn't do very well. The average investor would be 10 times better off just putting 50% of their money in an index fund and 50% of their money in a savings account. They would be much better off that way. In fact, if you want to be a better than average investor, I just told you how to do it. Now, if you'd like to improve on that, you might want to get to the seminar. Just go to bullingtoncapital.com to sign up for it. It's free. They're fun. I'm a big fan of sharing as much knowledge and information. And I'll ask you that, if you have questions, feel free to write in and ask questions. I don't have a problem with that at all. In fact, I like answering even the hard ones. People think they're going to offend me. You're not going to offend me. I promise. You won't offend me, no matter what your question is. In fact, we just updated the website while I was speaking to you. Actually, my marketing director did. Having a good investment strategy is not going to help you if you pull out of the market at the wrong time. That's a big one. That's a big deal. You can help yourself succeed by following a couple of simple and effective investment strategies that match your investment personality. I'm going to show you how to identify your own investment personality. And then I'm going to show you how you can allocate your assets. If you want to do it on your own, that's great. And by the way, my clients are people who don't want to do it on their own. They recognize the value and the amount of time that it takes to have to do this stuff, and that's great. But if you do like doing it your own, come on board. I love the discussions with people who are more sophisticated. I love it. I eat, sleep, breathe, and dream this stuff. So, I'm lucky. I don't really feel like I'm ever working. How's that? I really don't feel like I'm ever working. So I'm lucky. That is really lucky. I understand. I talk to people who have jobs that they can't stand. Man, I mean, that's like being in prison. You spend so much time there. Holy cow. And that's one of the things I'd really love to do. I'll get around to it, I guess, when I get ready to retire. But going around and talking to 12-year-olds, they have enough resources now that they can go online, look at the various careers, explore them, find something that they think they would like to do. That's a big part of being able to be successful financially. And incidentally, I know we're going to be taking a commercial break here. I just want to give a shout out to the estate planning team. These guys also do a show here. I believe is it 9 o'clock in the morning? It's 9 o'clock in the morning. And they do a good job of the financial planning portion of this. And there are two basic things you really got to get right if you want to be successful financially. The first one is you got to learn how to live beneath your means, not within your means. You got to learn how to live beneath your means. That is not easy. That's tough. And the estate planning team is willing to sit down, work with you, go through a budget. They don't sell product, by the way. They don't manage money. They do the planning portion. I think it's really important. So the other part of it is now you've got to learn how to invest the money that you're saving, and you need to be better than average. Because I got to tell you, the average investor, that phone call just got dropped, by the way. If you'd like to call us, 216-901-0945. Apologize for any problems that we might have, and I was just told that was his phone that dropped. So, whew. You can call us 216-901-0945 if you have any questions. And again, we're trying to. So there are two things you got to get if you want to be successful financially in life. First one is you got to learn how to live beneath your means, which means you need to really sit down and go through a budget, try to figure out where you might be able to save money. Then you need to be an above average investor. With interest rates as low as they are, and by the way, the interest rates are rising, which I thought was hilarious that on the day that they raised interest rates, all the bond prices went up, which is the exact opposite of what it's supposed to do. And why do they do that? Well, we'll get to that a little bit later in today's program. I've only got a couple minutes here before I go to commercial break. And I believe I've got, it's probably Daryl. Somebody is ringing on the phone. It's probably Daryl calling back. But we'll see here now that I'm in a million different places at once in my mind. Anyway, it was funny. The bond market already had been anticipating that interest rates were going to go up. So when they finally announced that they were going to go up, bond prices should have gone down. They went up. We'll come back to that in a little bit. I got to really quickly switch over to Daryl. Daryl, how are you doing?
Good morning. I'm well. Yourself?
Oh, pretty good.
You sound good.
Oh, thanks.
You sound good. I happen to see an article on Facebook, which of course has got to be true because it's on the internet.
Right.
But it indicated that there were dangers in having your investment in cash, that there might be some sort of a crash that might happen that would cause the value of cash to diminish. And I can't imagine how that would be, and I figured you might have some insight to that.
I would bet not more than $10, but I'm going to bet that is an ad for gold. That is the classic.
It even said that people were pulling money out of gold.
Where were they? What were they advertising?
I didn't want to click on it and give my. They were they were offering a free ebook.
Yeah, they're selling a product, and cash. If you're afraid of cash, and it depends on how they're describing cash. By the way, there is actually no formal definition for that. There are a lot of cash equivalents, so people will say cash when they actually mean something else. So commercial paper that's less than 90 days in maturity, has a AAA rating, is considered cash by a lot of people. Other people go, oh, that's got risk. Some people, cash is a short-term CD or a short-term treasury. Some people, cash is a money market account, and there are different types of money markets that invest in different types of things. So they really have to define what they mean by cash. And to a lot of people, cash is the money I got in my pocket. Okay, so just using cash without going a little bit further and then trying to scare people, that is a technique that's as old as Methuselah. Anyway,
I don't have to worry about the $5,000 in my checking account.
Right. Yep. That's right. Hey, we'll come back to this when we come back. Thanks for calling in. You're listening to Bill Bullington right here on 1420 The Answer. We'll be back after these messages. And welcome back. I was just watching. I went to the Vacation Fixation website. It's pretty cool. You just go in, fairly simple. Type in where you'd like to go, the dates, submit it, and they will actually give you a whole list of choices. And so anyway, that's pretty neat. I did get a question. Somebody emailed it in, which you're more than welcome to do. It's bill@bullingtoncapital.com, or you can go to my website, and there's a contact us form. You can actually just type a little note in there and send it. Somebody asked for my opinion on National Beverage Corporation company. The symbol is FIZZ, Fizz, which would typically make me want to trade it just because it's a cool symbol. And I'm being facetious there. The reality is it's a beverage company, kind of like Coca-Cola, not nearly as large as Coca-Cola is. So it came up on a momentum screen. It's come up on it several times over the past couple of months. Okay, first time it came up, it was right around $52. It's at 77 now. I did not buy it, by the way. It came up at 55, and it came up again just recently at 66. So it's at 77 right now. The chart looks a little extended. Like it could easily pull back here. Any stock can pull back at any time, but this one's run a long way in a relatively short time without any sort of a correction. So from a chartist standpoint, if you're going to buy this one, put a really tight stop on it. If you don't know what if what I said doesn't mean anything to you, then ignore it. That's my advice there. If that doesn't have meaning for you, if you're scratching your head, then don't pay attention to what I just said. Why? Because you're probably going to get hurt. You need to know a little bit more than that before you start investing in different stocks. And I'll look up the fundamentals right now. And I did look at it for quickly. These guys had revenue of $793 million in the past 12 months. The market value of the stock is $3.6 billion. So they call that market capitalization. So if you added the number of shares times the current share price of 77, the stock's market value is $3.6 billion. And they've got close to $800 million in sales. That puts your price to sales ratio at over 4.5 times. I'm not a big fan. At 4.5 times for a beverage company, that's fully valued. So that doesn't mean it can't go higher, because all the traders who don't even look at things like what the company's actually really worth, they've already pushed it up a long way in a fairly short time period, and there's nothing saying that they can't push it up higher. I don't know, now that there's anybody else, by the way. So if you're an investor, forget it. It's already fully priced. In fact, based on their profit margins, probably a little bit overpriced. So if you're looking at buying and holding something like this, I wouldn't do it. The chances of you making a lot of money are relatively slim. As a trader, it's already it's got some risk, so I would keep a tight stop on it. And if that doesn't, again, if the trading part confuses you, ignore it. Because you don't, if you're not a trader, if you don't understand what a trailing stop is, what a chart that's extended looks like, you shouldn't be doing it. Okay, you need to learn a little bit more about that. And we are going to be starting a website and a service where I'll talk about those things on that particular website. It's a separate business from Bullington Capital. It's something I do, something I like to do. And we're going to take the last 15 minutes of today's program and talk more about that in a little bit more detail, because we are just about ready to let that thing go. I mean, by letting it go, I mean making it live. So it's fun. I like it. But I have to tell you that it's an acquired taste for a lot of people. For some people, they're never going to like it. Some people are going to like it and love it right away. And we'll learn more about that a little bit later in today's show. But I just wanted to, again, come back and really stress how important it is that you get with investment strategies that you think you like. If they sound good to you initially, and this is kind of how I look at things. If I read a prospectus, an investment manager, and this is back, well, I'm still reading them. I still read them all the time. In fact, Fidelity sends me a ton of them, and Fidelity's really open with this. They put out a ton of material, by the way, but a lot of it is very instructional. In fact, you could just read the written material that Fidelity sends you, being a Fidelity client, and learn an awful lot about investing because those guys are pretty open. In fact, that's where I got a lot of my education from, just reading about the things the guys that Fidelity that work for Fidelity were doing. And it's not rocket science, believe it or not. It really isn't. You can try to make it rocket science, but it's not. It's relatively simple stuff. Can it be complicated? Well, it can be as complicated as you want to make it. That's the other part of the business that I don't find all that appealing. If you have a penchant for complication, you just like the complicated stuff, then you like to make things super complicated, you are probably not going to like Bullington Capital. That's for sure. Because I like to keep things as simple and as easy as they possibly can be. And I don't like to ignore things that are important. That's a big one. Trying to figure out which things are important, which things aren't. That's a task. That takes a while. That's why most people don't do all that well at investing, by the way. That's the first thing you've got to figure out, is what is real news and what is news that's nice to listen to, but is not going to have an impact on my investments. That's hard. That is incredibly difficult for some people. And everybody has a different method of dealing with that, and they do it in different time frames. Some people never get it. Some people get it right away. And they're all across, all over the map. But that's what we're doing in the seminar. What are you as an investor? Are you upset when the stock market's down 10% and your investments are down 10% or more as well? If you're upset with that, then you don't need to be 100% invested in stocks. That's how simple that is. I mean, think about it. If you don't want to be down more than 10%, and you know the stock market has a tendency to go down every 12 to 18 months, 10% or more, then don't be 100% invested in stocks. It's that easy. None of my colleagues speak that way. They like to make things incredibly difficult or complicated. I don't know why they do that. That confuses people. People need to know what they're doing, have a realistic expectation so that they're not going to be like the 2 out of 3 people that managed to locate the best mutual fund manager that's ever lived and ended up with losses because they didn't understand. They didn't realize that, those returns are not like a straight line. Those are the average returns. When you average the ups and the downs, that was the average. It wasn't straight up. So they didn't know that. And they didn't have internet back in those days to learn more about it. So the communication was not as good. And even though we have all this communication, people are still not talking about that. And I think I understand what they're doing. I think I understand what they're doing. By the way, I just got an email. This is pretty funny. Jerry, monthly fees and what type of information is discussed? For which? Which service? Think it also AAOI. I think it can be traded long or on a short-term profitable basis. I'm not a big fan of short-term trading. I am not a big fan of short-term trading. That is too difficult, and it depends on how you define short-term, by the way. The short-term trading to me is over a few days or a few hours. I'm not a big fan of that. I'm really for longer-term trading, like AAOI. If you're buying that came up on the scan so many times, and you'd have been stopped out 2 or 3 times, but you'd have made a lot of money trading that using the stuff that you'll see on the Lookout for the Bull website. So where is it now? It was up 5.8. Remember last week, by the way, Jerry, you were asking about that. You're a little upset that it was down. Well, it was up 5.86% yesterday. So that's what I'm talking about. You got to get used to volatility, and if you're not, you're going to miss those. But I got to take a real quick phone call, 216-901-0945. And Walter.
Hey, Bill.
Hey.
You were mentioning Peter Lynch?
Yeah.
I read in one of the financial magazines, that was a super great run he had, for that 13 years.
Right.
But according to the article, it said that the S&P 500 index was up 15.8% in that period. So he had a very strong wind at his back.
Oh, he did. Absolutely. But he beat it by more than 100%.
Right. But, had you invested in the S&P, you would have done very well, too, but not as great as he would have done.
Right. And that's exactly right. You know why? Do you know why the S&P did so well?
Why?
Because they're stocks. Because stocks actually had a very strong period. Now, they weren't strong for his first, 6 years. He was strong. The stock market was not. In fact, the stock market was so volatile from 1978 to 1982 that a huge number of people just threw in the towel and said, forget it. We're never coming back to stocks, especially with interest rates that were in the high teens in a money market account. So you see why that would attract people into money markets and savings accounts when the rates were so high versus a stock market that the average fund basically went nowhere. The S&P 500 went nowhere. It had up and down. It was in a 25% trading range for 4 years in a row. So, and that's why I'm not a big fan of the S&P. I'm not a big fan. It's the only, if it were my only choice, or any other market cap weighted index, by the way. That's the fatal flaw, in my opinion, in market cap weighting. When you're adding more money to Microsoft when it's $200 billion than you did when it was $2 billion, you're hurting yourself. You want to have more money in it when it's $2 billion, or at least an equal representation when it's $2 billion than you do when it's $200 billion. Does that make sense?
Yeah.
So if you're going to invest in the S&P 500, do it on an equal weighted fund, not market value weighted. At market value weighted, it leads to bubbles and overvaluation and some really long time periods where you make nothing. And that is incredibly difficult to stick to when you're flat or negative for 10 years or more. I am not interested in that. And that's the problem with market value weighting or market cap weighting, is it leads to periods like that. And over the past 5 or 6 years, that's where all the money, about 80 cents on every dollar that's come into the stock market has gone into a market cap weighted index. And now you're looking at the biggest components in those indexes, those companies that are the biggest that they keep adding more money to. Why? Because they got bigger. Okay, they're adding more money to that, and they're overvalued. So there's about a third of the companies in the S&P 500 who are selling at 10 or 15% higher than they should be, and there's about 10% of them that make up about 30% of the value of that index that are selling for 25% more than they should. So I'm going to tell you right, unless people keep buying them, and if they do keep buying them, by the way, they're going to keep going up. As long as people keep buying them, they will keep going up. And regardless of the value that they're getting for their dollar. So that's a key. And knowing that, you can now look for investments that are doing something different than that. Because inevitably, that's going to lead to another period where the S&P 500 performs poorly, and everybody that invests in it gets upset, and they think that the entire investment community is conspiring against them. Because I've been doing this for a long time, and that's typically what happens. And I just don't think it's a good thing. I think there are alternatives that you can do, that you can take, and you can do better. And even if you don't beat the average performance, the fact that you're not down 50% twice in one 10-year time period, that's a big deal, especially if you're taking money out of the accounts to supplement your retirement income. You can't afford a 10-year negative time period. I mean, think about that. If you just retired in March of 2000, 10 years later, you are probably looking for another job investing in the S&P 500. Does that make sense?
Yeah, it makes sense.
Yeah, so you got to do something a little bit different. And fortunately, there are lots of options available now, more so than there were when I started in the industry. So.
Quick update on Warren Buffett. I just heard this 2 weeks ago.
Right.
That the contest between Warren Buffett and the hedge fund. Remember that?
Yeah, well, those hedge funds that he's talking about, they those guys charge a minimum of 2% of the assets plus 20% of the profits. That is really difficult to overcome. I mean, incredibly difficult.
Well, they said the latest comparison was Buffett's up 85%, the hedge fund or whoever he's comparing 60, against was up 22%.
Oh, those numbers were wrong. I don't know where they got them. And actually, the S&P was up more than that, and but the hedge funds were only up about 60. There was a big difference in it. And hedge funds are incredibly expensive. I mean, incredibly expensive. But if you're looking at other type, like the fundamentally weighted RAFI S&P 500, not it's 1500 stock, it's beating the S&P 500 since its inception, which is really wild because normally a strategy will underperform the market 4 or 5 years in a row. A good strategy, a strategy that has a great long-term track record, doesn't that make you excited to run out and find them? To realize that you're going to have to, you might underperform the S&P, but here's the deal. Sooner or later, that fatal flaw of adding more money to Microsoft when it's $200 billion than you do when it's $2 billion, and if Microsoft goes up 10%, they're going to sell some of the smaller companies and add it to Microsoft after it's gone up. Okay. Eventually, that comes back home to roost, and it blindsides people.
One last question.
Sure.
As interest rates are going up, okay, aren't annuities affected by higher, bond rate, getting a better bond yield? Aren't less people going to invest in annuities, and therefore the annuity companies are going to try to make up for it by charging a higher fee or expense to be in an annuity?
I don't know, but I can. I have to take a real quick commercial break. If you want to hang on, we can talk about it when we come back.
Okay.
Okay, you're listening to Bill Bullington right here on 1420 The Answer. Stay tuned. I will be right back.
Money, 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 money.
And we're back. Hey, Walter, you still there?
Yeah.
Okay, so annuity and interest rates going up, it depends on the type of annuity. There are tons of different types out there. But you're right, some of them will actually have increased expenses. That's already written into their contracts if you bother to read them. Many of them are not showing that increasing costs, though, because they don't even tell you how they're investing the money, especially the equity indexed annuities. They don't tell you exactly how they're investing the money. They just tell you what their guarantees are. That is crazy.
I mean, you just hear these annuity commercials. You can't get away from them.
I know. It's because they pay 8 to 10% commissions, and I could retire tomorrow if I converted my entire client base to those annuities. I'd be out of here. And by the way, I'd buy a jet.
But
yeah.
Everybody's saying right now the interest rates are going to go up more this year. Maybe 3 more times, 2-3 more times.
Your guess is as good as anybody else's as far as that goes.
But the thing is, usually dividend-paying stocks then sell off somewhat because people get into like a 10-year bond.
Okay, I'm gonna ask you then to point out the exact dates and times every time that's happened in the past.
Well, I couldn't tell you that then.
Okay. Well,
but I'm just telling you what people say.
Okay. Yeah.
And my whole point is I think that would affect annuities the same way, that instead of buying annuities, some people might say, hey, I'll put my money in a 10-year bond or, with interest, with the yield getting better. And so demand for annuities will go down just like for utilities or dividend-paying stocks. I would think it would have the same effect,
Yeah. Well, it may for some people. Whether or not it's going to have a big impact on that market is another question altogether, and you won't know until it's too late to do anything about it.
The other thing I would ask you about annuities, one last question, is that when I keep on hearing, it's safe, it's guaranteed,
right.
But the government doesn't guarantee
No,
annuities.
the guarantee does not. That's a guarantee by the insurance company. And I'm telling you.
What if they experience problems?
Then guess what? The guarantee goes away. Remember
that's
those?
Not a guarantee then.
It is a guarantee. It's a guarantee by the insurance company. I could guarantee you anything, and it's going to be based on my ability to meet that guarantee as to whether or not it actually comes true.
Okay, has that ever happened that whatever
Yes.
you get in annuity, like on a monthly payment,
Yep.
that payment was cut over time?
More than once.
Okay, so they cannot guarantee you're going to get the same amount that you're getting now in the future.
They will guarantee you that, but they may not be able to hold up their end on the guarantee. Then they go through a reorganization, what is also known as a bankruptcy, because their liabilities have gotten greater. And insurance companies, by the way, rarely call it a bankruptcy. It's a reorganization. The company typically finds buyers for their business. They're forced out of business because they have to keep a certain amount of capital, just like a bank in reserve.
Yeah,
and,
right.
Yeah. And then what happens is the companies that take over their business make an offer, and typically it's an offer with lower guarantees that they're pretty sure that they can afford at the time that they make those guarantees. So you're getting a guarantee from one insurance company to make up for the guarantee that the other insurance company couldn't follow up on or follow through on. And it's still a risk because if that company can't make good on their guarantees, they're going to go through the same thing.
So it is a possibility that you would get reduced payments in the future.
Absolutely.
And they never tell you that.
Well, they tell you that it's not going to happen. That's really what they tell you.
Yeah, that's deceptive, in my opinion.
Well, you know what? You got it. I think there should be a federal Department of Insurance. Everybody, no more government regulation. Well, you know what? These guys there are a lot of insurance companies that are just bad players. They're bad players. There are other insurance companies who are trying to do the right things, whose rates that they can guarantee safely are so low that nobody wants to do business. Nobody wants to buy that.
And Bill, here's another thing about insurance companies. Annuities aren't the only thing they may do. They may do casualty and property.
Yes.
If they suffer big losses and they fail to meet their reserve requirements, then they have to, do something, cut your payments.
Right. And here's it. If you're looking at an annuity to invest in, this is a key. Okay. you want a variable annuity that's got mutual funds in it, because the mutual funds are not in custody at the insurance company. They're in custody of the firms that manage the money, the Fidelities, the Vanguards, the T. Rowe Prices of the world. In a variable annuity, they have the money. They're the ones that are managing the money. The insurance company is actually just doing paperwork. And you can get really good deals on those. The ones that are guaranteeing income, they're guaranteeing your principal, and your thing will never go down. I'm not a big fan. I am not a big fan. But the investment-only annuity, I am a big fan of, because you can get access to funds. Some of these funds have even been shut down to the general public. So you can get access to funds on a tax-deferred basis. That does make a big difference in your returns over time. You just don't want to overpay for it with all this unnecessary insurance expense that's probably going to reduce your returns to little or nothing. You know what I'm saying? So it's one of the banes of my existence is having to read through all these things, because there are a lot of clients out there, and a lot of my clients, can you look at this for me? The vast majority of the time, yes, the devil's in the details. There are extremely large expenses. Whenever you hedge, that you're basically taking out an insurance policy against volatility. Those insurance premiums have gone up substantially over the years, and there aren't a whole lot of really good deals except for the areas where you can just invest. And they're not, the insurance company's not making any promises. They're just doing the paperwork, letting you pick the mutual funds yourself. We will actually manage those portfolios at Bullington Capital, but you don't have to use us. You can go out and get those products on your own. And the tax deferral is a big deal. In fact, one of the ones I use, their total admin fees are $20 a month. It doesn't matter whether you have 50,000 or 50 million. It's only $20. That's the admin fee that the insurance company charges. So there are some good products out there, but there are a lot of bad players. And, it's tough. You got to really buyer beware. That's the way that works.
Well, thanks for answering my questions there.
Well, hey, thanks for calling. I appreciate it. And thanks for listening to the program.
Okay.
Have a good weekend.
Bye.
Thanks. And we're almost done here. I meant to spend a little bit more time. So we cover a lot of topics. I apologize. I feel so bad. The next seminar, we're really going to kind of just do a couple little exercises on how to identify which strategies you should be investing in, whether they're with me as a client or on your own or in your 401k. You probably want to get to that workshop, because I'm going to teach you really quickly some pretty slick tools. I think they're slick anyway. Of course, I'm the one that made them. But on evaluating yourself and then being able to go out and pick the types of funds that match your investment personality profile. Yeah, everybody has an investment personality. Some people are super aggressive. Some people are super conservative. How do you pick a general strategy that will suit you so that you're not selling when stocks are down? That's a key. You got to come up with a strategy, and this is very important. Most financial planners, and this is one of the things I liked about the estate planning team. They don't do this, okay? But a lot of financial planners, especially those financial planners who get paid to put you into products, okay, they have a tendency to gloss over the investment planning portion of their plan, or they don't pay a lot of attention to it. And I'm going to tell you, that is probably, it's tied up there with figuring out how to live beneath your means, because if you don't save any money, you got nothing to invest anyway. You'll have to work till you die. Okay, so that's the first most important thing, is figure out how to live beneath your means. Which means you're going to have to do budgeting. You're going to have to look at costs of different things. How much money you're going to set aside for retirement, how much, all that kind of stuff. And those guys do a good job of that. So we do a general job. I don't do specifically details. I'm not going to sit down and go through a spreadsheet and a budget with you for that. It's not what we really do, because the second most important thing you can do is be a good investor. That's the second most important thing. It's my personal opinion. And when you figure out how much money it takes to actually replace your income, the vast majority of people that figure out how much money it takes to replace their income, or to even just to generate an amount of income that you could live comfortably on, which means you will have done a budget at some point in time, so you know what your basic living expenses are. If you know what your basic living expenses are, and then you multiply that by 20 or 25, which is basically saying I'm going to take a 4% or a 5% withdrawal each year. And it's a big number. I mean, it's a really big number. And this should take precedence over everything else. It should take precedence over your kid's college. Why? Because unless you want to move in with your kids, when you're older, unless you've got the money set aside to be able to fund your own retirement, you're going to have to work until you die. I don't know. I'll probably work until I die, but it's not because I have to. I like what I'm doing. It's a lot of fun. I've only got a few seconds here left. If you've heard something today that you'd like me to talk more about, you can always email me, bill@bullingtoncapital.com. You can go to my website, sign up for the seminar that's coming up in May. Give you, I think we've got about 6 or 8 weeks. And feel free to always call us 330-664-0700. If you want to get a copy of this, you can go to iTunes, search for the Bullington Capital Report. You can also go to my website, bullingtoncapital.com. And with all that stuff, I'll just, I think I only have a few seconds left here. I wish everybody a really good week. Good luck. Good investing. I know that's grammatically incorrect, but anyway, I'll see you again talk to you again next week. 11 o'clock, 1420 The Answer. Have a good week, everybody.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.